Hi guys, and welcome to our Monday trading tip of the week. And today I want to talk about dividend yields, because not a lot of people think about dividends and not a lot of people actually reinvest the dividends. In fact, a lot of traders, when they're buying and selling shares, they generally don't hold them for long enough to be able to really get the sizable capital gains from reinvesting dividends, understanding what dividends really are and the yield that you get, and over time compounding both the dividend return, buying more shares, getting the appreciation with the share price, and over time getting a really sizable return on investment. So let's first of all talk about what a dividend yield is. Now, it's pretty simple to understand. Every company that actually pays a dividend is going to announce what sort of dividend it is going to pay per share that you own. Now, a company may decide to pay dividends depending on what market the company is listed on. In the US, they'll pay dividends quarterly. Some companies pay them depending on what index they're listed on, half yearly, and some of them pay annually their dividend or announce their dividend annually. Either way, on an annualized basis, whether it's quarterly, half yearly, yearly, you're going to know with respect to the shares that you own of that company, what is the dividend they're going to pay you per share. Now, to work out what the yield is, the percentage, you simply divide whatever it is, the amount they're going to pay you per share, divide that by the share price. So in the example of you're going to get a $2 dividend per share, and let's assume the share price is $20, you divide the 2 into the 20, and that's going to give you your dividend yield. Now, this is a floating amount because, of course, the share price over time will likely appreciate if you've bought a great quality business, and therefore that the yield is going to get a little smaller if it was the same at $2 and the share price went from $20 to $40. Obviously, 2 into 40 is a little bit less than 2 into 20. So therefore, what we can do as an investor, if we own the physical shares, we won't get paid our dividends and be able to reinvest and be able to get the same sort of capital growth as on CFDs as you can on physical shares. But if you reinvest those dividends, over time, you're just going to continue to compound money. Compounding is the eighth wonder of the world. And with respect to what you can achieve over a 3, 5, 10-year period, compounding with dividend yields of around 3 to 5% on great quality listed businesses, it can simply be outstanding. So when it comes to you looking at buying some shares in a listed business and you're looking at the quality of that business, always have a look and see what the dividend yield is paying, or better still, the 5-year average dividend yield. Now, there are many long-term businesses that have been listed on the New York Stock Exchange, the FTSE, the ASX 200 in Australia, particularly banks and organizations like that generally pay a reasonably higher dividend yield compared to some other startup businesses, perhaps some tech stocks, etc. In fact, Google doesn't pay a dividend at all. So when it comes to you looking at the length of time that you're looking to hold some shares, look at the dividend yield and look at compounding effect of what you will get over a likely 3, 5, 10-year period based on the past 5 years. And what it will show you is great quality listed businesses with reasonable dividend yields of between 3 and 5%. Compounding those returns over time is going to provide you highly likely with an outstanding return on investment that will likely beat giving your money to somebody else, a fund manager or broker, to manage on your behalf. I hope you found that interesting, enlightening, educational. Until next time, happy trading.